Almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Chinese shares gaining in Hong Kong as traders return from holidays on fresh signs that recovery is gaining pace. Investors also assessing U.S. data, supporting the view the Fed will be slow to cut rates. The yen remaining on intervention watch with 152 to the dollar, seen as the key number. Strategists telling us authorities could target a 5 yen rally if they decide to act. And is the sell China, buy India strategy coming to an end? We have a special guest this hour to give us his take. Mobius Emerging Opportunities Fund Chairman Mark Mobius will be joining us live very shortly. Let's get you to markets. Pretty muted gains here in Asia, pretty much boosted by Hong Kong back from a holiday. It is up more than 2%. Of course, we have a stronger than anticipated eco data supporting the Fed's higher for longer. Bond traders now pricing in less than a 50% chance of a cut in June and fewer cuts for the year as well. Take a look where we are in terms of the MSCI Asia-Pac Index up, extending the gains for today to about 0.5%. Now, we talk about Hong Kong. Xiaomi jumping as much as 15% on early signs of success for its EV that is called SU7. It received 90,000 orders within the first 24 hours. And of course, in China, no momentum there after it rose the most in about a month on Monday. Two sets of data suggesting it is recovery. Currently, though, CSI 300 index down 0.2%. And speaking of China, it is about the yuan, 726.20 versus the USD weakening ever so slowly there to that 728 mark, which we are keeping a watch on. Of course, we had weakness persisting despite yet another strong fixing by the PBOC. And speaking of currencies, the yen on watch as well, weakening towards at 152 versus the USD. Finance Minister Suzuki tried talking it up, but nothing we have not heard before. Now, speaking of Japan, Japanese officials ramping up their warnings against speculative moves in the yen. Let's discuss the prospects for intervention and more with our guest this hour, who is synonymous with emerging and frontier markets investing. Mark Mobius, chairman of Mobius Emerging Opportunities Fund, joins us from New York. Also with us, MLive managing editor Mark Cudmore. Cudmore, let's start with you. This intervention, it ain't coming, not for the moment though.
I don't think so. Remember, it is pace, not just level. And who cares if it comes? You still want to sell the yen at the moment. Remember, we're talking about a very incremental change in its policy recently. The fact is, Japan still has by far the most deeply negative real yields in the world. And the environment, as I'm sure Mark Mobius will tell us in a few minutes, the environment is very constructive, broadening constructive for EM at the moment. And at that time when you want to be expanding your investments in discounted EM assets around the world, the yen is going to stand out as a funder. It does not have a strong economy. Sure, they're going to have to tighten policy this further, but it's not going to be enough to significantly close the gap of rates around the rest of the world. And so therefore, even if we get intervention, it just means a few yen difference, and soon we'll be moving back on to shorting the yen again.
So pretty much short-term gain for the yen if intervention comes. But when will intervention come? 155?
Look, it's better pace. I think if we get to 155 slowly, I don't even think it comes then. If we break 152, take out those barriers, and we suddenly go on a big stop-loss run, perhaps outside the Asia hours, and there's a little bit less liquidity, we get to like 154 really rapidly, I could see them coming in and intervening. But they don't want to fight the fundamentals here. They know they're on a losing battle unless the whole dynamics changes, unless we suddenly get a change in the US economy and we start seeing Fed cuts come through for real.
Mark Mobius, let's get you into this conversation. It is about the Fed. It is rate differential that is guiding the yen.
Well, at the end of the day, I think I agree with exactly what we just said. The Japanese are fighting a losing battle, and they might as well give up. There's no way that they're going to do anything to strengthen the yen, and it'll probably continue to weaken. At the end of the day, it's probably good news for some people, because if you're shorting the yen, you're doing fine. But the other interesting thing about the yen and about Japan in general is that a lot of the Japanese investment money is finding its way into Southeast Asia and to emerging markets generally. And I think that's a very interesting development, because they realize now that they have to make their mark, like China has been doing in these countries. And so the yen will be distributed widely in these emerging market countries.
Mark Mobius, we talk about how the yen, the weak yen, is supporting the stocks. We're looking at a 50% upside in the last 12 months for Japanese stocks. I mean, how much more upside can be expected? I mean, the likes of Larry Fink says as long as the yen remains at about 150, we can expect Japanese stocks to continue to go upwards.
The trend is your friend. It will continue to move up, not because of the yen necessarily, but because of what's happening with Japanese industry and what's happening in the chip market. You know, the chip revolution globally is becoming more and more intense with more sophisticated chips being produced, and Japan is at the forefront of this development. So that is going to help them a lot. And you notice that in Korea, chip exports are really leading the export revolution that's taking place there.
Mark, as you say, Japan stocks, the trend is your friend. There's structural reform happening. Yes, they've come a long way over the last couple of years, but it's not like they're long-term expensive yet. It still seems like good investment. But they're probably unlikely to continue leading the kind of gains in Asia. Or do you think they can continue leading the gains? If you think it's somewhere else in Asia that can start kind of taking the forefront of gains, where is your pick of the other Asian equity markets?
The pick for me is India. India is the place, even though India has come back a lot and it has even at some point outperformed the US market, India has still got a long way to go. And by the way, Japan is going to play a role in India. As you know, relations between Japan and China have not been the best. China's been a big market for Japan, but they realize that this cannot continue. And they're beginning to make a big push into India, and that's going to boost not only Indian stocks, but also it's going to help the Japanese stocks as well, those who are going into India.
Mark, are you not concerned by just the extreme valuations we're getting on the India story? I understand the structural story. You've got incredible growth. You've got great demographics. Long term, it's brilliant. And I know you've been a long-term fan of it. And I know it's going to be there for some while. But the valuations in Indian stocks, they make US stocks seem discounted and cheap. And I kind of think that, you know, if you're looking to play, I'm not saying you want to fight that trend. And like you, you know, the trend is your friend, and I don't want to go against it. But I just don't see it where the most upside for the year ahead. There are a lot of other Asian stock markets, like Vietnam, like Hong Kong even, that just seem much more discounted compared to India. What would you say about that kind of rebuttal?
That's a very interesting point you make, because if you look at price earnings ratios, yes, it looks cheap. If you look at the Hong Kong market or some of these other markets compared to India. But what we like to focus on is return on capital, return on assets. And if you look at the Indian companies in that regard, you find that they're doing exceptionally well. And what we found over the years is that companies with a high return on capital, high return on assets, tend to catch up on the PE level. In other words, the PE level is high at the time when you notice this high return on capital. But as you go forward, that PE level is going to come down as a result of this high return on capital, because the earnings are going to be growing faster than the price. So yes, this is one thing that a lot of people are afraid of, is the high level of the price earnings ratios, which makes India look expensive. But we look at it the other way. We look at, you know, what's going to happen down the road, and they're doing exceptionally well.
The thing is, Mark, the Indian market regulator is also seeing a bubble. In fact, it's been coming up in arms, trying to, you know, moderate sentiment in the market. We've seen this before, and they say that they're seeing perhaps exuberance, particularly in mid and small caps. I mean, how are you assessing that?
Yeah, the Reserve Bank tends to be very, very conservative and concerned, which is why they probably will not reduce interest rates, because they don't want the economy to be overheated. And they see the stock market is booming a little bit too much. But as we've seen in the past, this kind of boom can last a lot longer than the central bank would like. And I think that's the case with India.
So, Mark, is it justified to take money out of India to go to China? We're seeing increasingly being done, and people say it is an inflection point. But from what you are suggesting, is not the right move?
Well, with China, I believe the place to look would be the government companies, because, as you know, Xi Jinping really wants to have the government companies dominate the Chinese market. So you might want to look there. But again, when you look at the metrics, when you look at return on capital, and even some of the other valuation metrics, you'll find that it's not really that attractive. In other words, there are not that many bargains that you'd want to go into, not only because of the change in government policy, but because the economy has also been slowing. In the past, you could sort of throw money at anything and it would work, but nowadays you have to be a lot more selective. And for that reason, we're sort of watching it very, very carefully, and maybe picking one or two stocks that might be able to perform, particularly if they have government backing. And that is the important factor, I think, that you're seeing in China.
Mark, you made the point there that, in China investment for the last couple of years, stock selection has been so vital. Obviously, just investing in the indexes hasn't worked. It requires much more kind of active management. You talk about the government companies being much more supported, and that makes sense, and that's clearly been the trend recently. I'm curious about, the idea that the Chinese government say they're supporting a high-tech kind of moonshot and very, very aggressive kind of plans for the expansion of the tech sector, and whether you think there's kind of any merit of moving into some of those kind of slightly more kind of tech startups, the small cap tech, again in China, that's been so battered in recent years until the last couple of months. Do you think this is the start of a nascent recovery there, or is there another false dawn?
No, definitely. I think it's a good place to start for the reasons you mentioned. The government is pushing the tech sector, particularly the high tech sector, particularly semiconductors and companies that support the semiconductor industry. But interestingly enough, one way to get into this market, this Chinese market, is through Taiwan, because Taiwan is supplying a lot of the technology. Even with the US restrictions, Taiwan is supplying a lot of this software, particularly the so-called fabless companies in Taiwan. Yes, there's some companies like that in China, which you want to look at, but you might want to also look at Taiwan as an entry into that Chinese market.
Mark, which Chinese stocks would you buy? Some suggesting tech is the way to go right now, Alibaba, even Tencent.
Well, the one I would buy is TSMC in Taiwan Semiconductor. That's the one that's really the winner. And I think, of course, the Chinese would like to get their hands on TSMC, and they already benefit to some degree from products from TSMC, but of course the US restrictions limit that. But that's the one I would bet on.
So no Chinese stocks? You will not be picking up any Chinese stocks?
Not at this stage.
All right. Thanks to our MLive executive editor, Mark Cudmore. Mark Mobius, chairman of Mobius Emerging Opportunities Fund, is sticking around, so bear with us. Still to come, Goldman Sachs shares their outlook on India's financial sector. Hear why they think the period of strong growth is over, at least in the near term. This is Bloomberg. Welcome back to Bloomberg Markets Asia. Now, markets expecting the Fed to wait until September for its first rate cut on the back of that strong ISM factory activity data. Traders also pricing in rate cuts in July from the ECB and Bank of Canada, and more moves from the BOE and RBNZ in August. Let's talk central banks. Continue our conversation with Mark Mobius, chairman of Mobius Emerging Opportunities Fund. Mark, we're seeing a catch-up rally in Hong Kong following the onshore rally yesterday. Is this a sign of more to come?
I think yes, it could be. There's a very good possibility. Yes.
In terms of how central banks are being factored into the markets, Mark, I mean, what assumptions are you making about the Fed?
I personally think the Fed will lower rates sooner than later for one particular political reason. That is, they really don't want the current president to be disadvantaged in the upcoming election. So I think Biden needs help from the central bank, and I think they may get it. They may give it to him. So I know that's an outside view, but that's what I think.
So markets have gone from 7 to 3 and now possibly 2. You say the Fed will move 3 this year?
Yes, I believe that's quite possible. Yes. You must remember that money supply has come down in terms of percentage growth. The money supply has come down dramatically in the growth rate. The growth rate has declined dramatically. And we're seeing the total money supply curving down. So they've already achieved that. And therefore, they shouldn't be worried too much about inflation. And it may be that they would be willing to lower rates at this stage.
We know that the Fed and the strong dollar have had a strong influence in Asia in particular. How do you see this playing out in this part of the world?
I think the strong dollar is great for the rest of the world because they can put their savings in U.S. dollar bonds and not worry. And so they love that idea. And of course, if they have a relatively weak currency relative to the U.S. dollar, they can export to the U.S. So a strong dollar is not necessarily a bad thing for emerging countries in particular, but other developed countries as well.
We know that you're looking at India in particular. How do you see the RBI factoring in Fed moves into its own decision?
I think they are watching it, of course, very, very carefully, and they're wondering, like we are, what the Fed is going to do next. But the big question mark in my mind is what China is going to do, because China needs to boost exports much quicker than they are doing now. And in order to do that, they may need to weaken the renminbi even further. And that could cause all kinds of conflict with the U.S. So it's going to be interesting to see how this develops. But I think that's one thing that we have to watch very carefully.
This is a PBOC that's quite reluctant to see a weak currency. In fact, today we saw a very strong fix, 1,400 pips below what was anticipated. I mean, how are you reading where the yuan goes from here, Mark?
Well, if you look at the numbers, if you look at the export numbers, you can see they're very weak. The Chinese economy, as you know, is weak, and they have to do something to boost either consumption, which really is what they should be doing, but confidence is so low in China, it's very difficult for them to boost confidence in consumer confidence. So I don't see any other path for them but to try to boost exports.
Mark, we're also keeping up on what the BOJ is likely to do. The next big challenge for the BOJ is to pull back from its stocks and bonds in the market. How do you see the BOJ doing that when, you know, it holds about 50% of JGBs and about 80% of ETFs in the market?
Well, as you know, the BOJ has been doing some irrational things for a long, long time, and it's quite possible for them to continue that. I think they have woken up to the fact that the past policies really didn't do anything to accomplish the inflation targets that they were pointing at. And now they're thinking about doing something differently. But it remains to be seen if they're able to have that confidence to really make a dramatic change in their policies. I'm sure there's a big debate going on within the financial circles in the government about this whole issue, what to do next. And it's not easy for them to change tack.
Is it possible for the BOJ to withdraw without causing market turmoil globally?
Yes, it is possible for them to do that. Of course, they have to do it gradually, but there's no question they could do it without creating any really big issue.
How about in terms of the yen as a carry trade? What are the prospects from here?
Well, from my point of view, you're going to continue to see weakness in the yen. And those who are shorting the yen probably will make some money. But other than that, it will not be dramatic. It won't be a big dramatic change. It'll be a gradual change.
Mark, just one final question on Japan. Some say that perhaps even as we talk about the economy improving, it's not trickled down to the people. How might this play out for Japan's economy?
Well, what happens in Japan, as you know, there's an incredible amount of discipline within the banking sector. In other words, the banks do what the central bank tells them to do, and they're very disciplined in that regard. So any direction the government wants to move, they will move in that direction. And of course, the Japanese public is very used to extremely low interest rates, almost negative interest rates, and they tolerate it because this is what the discipline is all about in Japan. So I don't see that any change in the government policy in terms of higher rates will not be objected to, of course. People will welcome that, but doesn't necessarily mean that will happen.
Mark, hang tight. Mark Mobius, chairman of Mobius Emerging Opportunities Fund, is sticking around. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. Some top corporate stories we're tracking. Singapore Airlines is reportedly resuming flights to 3 Chinese cities later this month, following a 3-week suspension due to what it described as regulatory reasons. CNA reports that services to Chongqing, Chengdu and Xiamen will restart on April 22nd. Singapore Airlines has not elaborated on the reason for the suspension, but this is not the first time it's had to pause flights. Tesla may be headed for a gloomy sales milestone as waning demand for electric vehicles and elevated interest rates take a toll. Analysts have rapidly lowered projections for this week's quarterly deliveries report, with some even braced for a first decline since the early pandemic. On average, analysts think Tesla delivered 449,000 vehicles. That would be down more than 7% from its record fourth quarter. And Rakuten Group is said to be coming back to the high-yield bond market with a $1.25 billion offering. Sources say the Japanese tech firm will use the proceeds from 5-year bonds to buy back debt due later this year and beyond. Early pricing talks are reportedly for a yield in the mid-10% area. But first, let's do a quick check on the market. Xiaomi jumping as much as 15% earlier this morning in Hong Kong on the back of orders for its first electric vehicle, topping estimates, fueling optimism. The smartphone maker may succeed in China's cutthroat car markets. We're seeing Brilliance China also surging by more than 30% right now. BYD, Geely Auto also in the positive. Gold is what we're watching as well. Close to record highs right now. Gold at $22.53. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back. China markets just heading to lunch. Right now, we have the CSI 300 index in negative territory, down 0.3% after rising the most in about a month yesterday. 2 sets of data showed manufacturing expanded, encouraging signs for exports, consumer prices as well, but not enough to lift sentiment, currently in negative territory. Of course, when it comes to China, we're keeping an eye on the Chinese yuan weakness persisting, despite yet another strong fixing that was more than 1,400 pips below estimates. Dollar yuan near 7.28. That's the level we're tracking at this point in time. In terms of the Shanghai COM, currently flat. Shenzhen COM down 0.2%. We're also tracking Japan as it comes back from lunch break. Japan, of course, it is about the yen in particular weakening towards 152 versus the USD. Finance Minister Suzuki has said repeatedly that, it is willing to take bold actions, but nothing so far. 152, unlikely, they say, to see intervention. Nikkei 225 currently up by 0.3%. The yen 151.72. Now, some say that 152 may not be the point of intervention. It could be closer to 155. Now, the RBA set to switch to a new framework for the implementation of monetary policy. The Assistant Governor for Financial Markets, Christopher Kent, outlined the changes in a speech at Bloomberg's Sydney office. He also spoke to us about the outlook for the central bank's policy settings.
The board's made it clear it thinks the interest rate path that will best bring inflation down in a timely manner is uncertain. And so they've not wanted to rule anything in or out with regards to interest rate changes. We're in a better place than we had been. Inflation's come down a long way. It does look to be moderating, but the path, according to our forecasts, is a gradual moderation from here. Labour market pressures, they're easing. They're still tight, but they're easing, and that's because growth's slowing, and so that brings demand into a better balance with supply. So all those things are in place. Our central forecasts are sort of predicated on sort of further good things happening, including productivity growth, but there's a lot of uncertainties around that. And I think the key point is those are reasonably well balanced as best we can tell, and because of that, the path's uncertain. The next rate change, don't know if it's higher, don't know if it's going to be a lower interest rate.
When you talk about the inability to rule out shocks, right? How much of those risks do you worry about that might be external, that might be geopolitical, that might be election-driven, the policies of other countries, and how much of it are sort of domestic, maybe structural macroeconomic aspects that perhaps we haven't seen in the data sets yet?
I think it could be both. We just don't know. But I mean, as a small open economy, we're always subject to developments offshore. We've talked quite at length about what's happening in China. China's a major export market for us, and there are concerns there about their property sector and the problems that they're trying to deal with there. So that can have an impact on things like the demand for our key commodities like iron ore, and that can move our economy around. But equally, domestically, things can be moved by what people here in the Australian economy are doing, particularly households at the moment. How are they going to behave in the future? That will sort of be a key point for where the economy goes.
And that was Christopher Kent, Assistant Governor at the RBA. For more on Australia, let's bring back Mark Mobius, Chairman of the Mobius Emerging Opportunities Fund. Mark, I mean, you do get a sense the RBA between a rock and a hard place.
Yeah, yes, but the bottom line is that the Australian economy is really in very good shape. If you look at the real estate market all over, but particularly in Sydney, it's really booming. Maybe overpriced, but the prices continue to rise. So Australians are feeling rich, and a lot of people want to be in Australia. It's a great place to live. And so that's the reason why they may have a little problem in getting inflation down. But generally speaking, the economy is in very good shape.
When it comes to Australia, Mark, it really is about the property sector. Prices keep going up.
Yes. I was recently in Sydney, and I realized why people want to buy property in Australia. It's a wonderful place to live. The people are really nice, and it's a great atmosphere, great climate, and it's a well-ordered society. So I think you're going to get, if they open the doors to immigration any further, they get a flood of immigrants coming in. So I think that's the problem they have. The problem with Australia, it's too good.
If you want exposure to Australia, Mark, how best to play that?
Of course, equities again. You have to be in equities in order to get exposure to that market. And I would say the service sector would probably be the way to go, because it's got a booming service sector and a service sector that's growing at a rapid pace. So I would say that would be one place to look.
Mark, take us through your investment strategy. I mean, how does your portfolio look like right now?
Well, right now it's very tech heavy. Now, when I say tech heavy, I don't mean tech stocks necessarily, but companies that utilize technology to improve their profitability and their effectiveness. And that could be in the service sector, it could be in mining, it could be in anything. But generally speaking, there is in our portfolio a tendency to be into software companies, companies that are doing any kind of software, either for AI or for chips or for any kind of item that you would cover in the tech sector. So, for example, if you look at India, Tata Technology would be one stock that would be very, very interesting because they are exporting software all over the world. But there are many, many companies like that that we would be interested in. Going forward, I believe the hardware sector in India will become more and more interesting as they move into chip production and as they move into production of other tech products.
How much more upside do you think there is to the tech space? If you take a look at what's happening in the US with NVIDIA, how it keeps testing new records. I mean, how much more upside can we see? And people basically are investing in the future in what's not really known yet. There's a risk to that.
Yeah, of course. Some of this has gone completely crazy. You get new IPOs coming up with no earnings, and that tells you that there's an incredible amount of money sloshing around the market looking for a home. And the sentiment is generally in favor of AI or anything related to AI, whether it be in chips that help the AI sector or in software or whatever. That's why you have stocks like NVIDIA doing so well. But there are many other stocks that are benefiting from this technological revolution, which have been unnoticed to some degree. But it seems that the sentiment goes after those more wild kind of cards that you see in the tech sector, stocks that promise an incredible future, but are not delivering yet and may never deliver. So you have to be very, very careful. We can't condemn the whole tech sector, but we've got to be very selective.
Can you name some of the stocks we should be picking up if you want to play tech and AI?
Well, we're now in the process of buying some of these, so we don't want to give those specific names, but I would say that you have to look at those stocks that are actually making money.
Which stocks and sectors are you staying away from, Mark?
Generally speaking, we don't stay away from any particular sector because we're finding opportunities in almost every sector. But if you look at the big picture, probably anything related to mining, but even oil production, there's some stocks that are doing very, very well. A company like Tidewater in the US is doing very well and have a great future. So even those kinds of stocks we won't avoid, but selectively we have to be careful in the mining sector. But other than that, we're not staying away from any particular sector.
Which market do you see overperforming, outperforming by the end of the year?
No.
Might that be China? Might that be Japan? Might that be the US still?
There's no question in my mind that India will continue to outperform. They're on of course, now they have the election coming up, but it looks like Modi will come back with maybe even a stronger majority in the Congress, and that will set him on the road to really push the Indian economy further up. So I think India is the place to be.
Not too long ago, Vietnam was also the darling for investors. Might Vietnam surprise investors?
Yes, Vietnam has been very high on our list, but the problem with Vietnam is that politics get in the way. And you have the problem with, as you have in China, where the Communist Party may decide, look, this private sector business has gone too far and we want to slow it down. And you've seen they've already taken some measures in that direction. So you have to be very careful. You may be in a terrific stock and then find, suddenly they are in a politically unfavorable position and your stock could go out the window. So that's something you have to be careful about with Vietnam. But no question, Vietnam is a very dynamic society, incredible future ahead. But again, the political aspect is something you have to look at very carefully.
Mark, we love asking you this question. If you had $100,000 right now, where would you invest it in?
I'd first of all put it in stocks, and probably 50% of it I'd put into the U.S. market, because although I love emerging countries, emerging markets, the U.S. Stocks have an incredible presence in the fast-growing emerging countries. If you look at the percent of earnings on companies like Apple or like Microsoft or so forth, the amount of money they earn overseas and in emerging markets is tremendous. So in some ways, the U.S. market is an entry into emerging markets. So I'd say maybe, and it's a very liquid market, of course, maybe 50% in the U.S. equities and 50% in the other countries around the world, but of course, it'd be emerging markets: Taiwan, Korea, Thailand, Indonesia, India, of course, Brazil, maybe even South Africa.
Mark, just one final question before we let you go. We know we'll have a rematch between Biden and Trump at the end of the year. What would Trump 2.0 mean for markets?
I think Trump might be good for the markets, because his first measure would probably to reduce taxes or do something with taxes to help companies, and it'd probably be good for the market.
Mark, thank you so much for your insights today. Mark Mobius, chairman of the Mobius Emerging Opportunities Fund. Thank you so much. Still to come, our interview with Goldman Sachs Asia Financials Research Unit. Hear why they've downgraded Indian banks to market weight as a sector. Keep it here with us. This is Bloomberg. Welcome back. Let's check the Indian markets just ahead of the open. It's opening in just under 1 minute. Of course, trepidation as we see weakness in the Asian markets at this point in time. The Sensex index pointing to a flat open. Nifty index currently flat as well. Of course, we're keeping an eye on the Indian rupee, which has been pretty resilient versus the USD, given the inflows coming into the Indian market. Now, Indian markets being reshaped by an influx of cash brought out by the country's inclusion in the key global bond index. Data show that foreign investors have pumped some $9 billion into eligible sovereign bonds since JP Morgan's landmark announcement in September. Now, the inflows are leaving a mark on a variety of assets, including corporate bonds. The yield on top-rated 10-year notes has declined about 30 basis points since the index inclusion announcement. Let's get perspective from our next guest. Rahul Jain is co-head of Asia Financials Research at Goldman Sachs. Rahul, good to have you with us. First off, what do you make of the sentiment towards the Indian market? Some say it is time to pull back.
Good morning, Haslinda, and hello to everyone. Our strategies actually are constructive on the markets, Indian markets. They have 11% upside on Nifty. But having said that, focusing on my own space, which is the financial sector, they moved it down to market weight. And we also downgraded the sector about a month back. So while we still remain constructive, there are pockets of opportunities for the investors that our strategists are saying that you got to be selective in picking and choosing what you're buying.
Why downgrade Indian banks? Are the heydays over?
So clearly, I mean, the Indian banks were in the Goldilocks period, so to speak, over the last couple of years, which was characterized by improvement in the top line, sharp improvement in return on assets, and a pickup in loan growth. We feel that now it's time that banks start to consolidate their ROAs. We expect the ROAs to start moderating somewhat over the next couple of quarters on a variety of reasons. One of which is, of course, tighter liquidity scenario that's facing the Indian banks. Second is the unsecured lending, where we feel that the credit cycle is already on. And third, the need to invest in expansion of capacity build-up to mobilize more and more deposits. So clearly, all of this is not very conducive for the top line, and investors will need to be select when it comes to picking and choosing the financial stock they need to own.
So there are areas of concern. Credit growth is a case in point. It is set to slow. How might that impact profitability at banks, you think?
So while we still believe that structural drivers are in place for the loan growth to sustain in line or higher than GDP growth in the longer term, but in the near term, we see some consolidation happening in the consumer retail space because we see that the household balance sheets are getting leveraged. And even the lenders who've grown this portfolio will need to consolidate if the credit cycle indeed plays out. That's going to impact the revenues both at the margins as well as fee income because these are highly remunerative product segments that banks have been growing or even the non-banks have been growing. So therefore, there will be impact to the earnings. We have slashed the earnings estimates by mid-single digits. We have gone below consensus now because we see some of these patterns play out over the next few quarters. So there will be impact to the top line first to start with, and if the credit quality worsens more than what we are expecting, there'll be impact to the bottom line as well. So clearly, there's going to be a negative, connotation to the lenders' earnings over the next couple of quarters.
Rahul, how about deposit growth? We know there's intense competition in this space. How do you see banks trying to boost that growth in terms of deposits?
That's a very good question. Deposits is an important part for Indian banking system. Almost 70 to 80% of lenders' assets are funded by deposits, and the loan to deposit ratio, what we've seen over the last couple of years, have inched much higher. We are sitting at the peak of the loan to deposit ratio for the banking system, and therefore we feel that it has to consolidate. Historically, whenever the LDRs have hit the peak, it has ensued by a slower loan growth. The lenders are, following different strategies. Some lenders have gone ahead and put up strong capacity build out, so they're expanding distribution footprint. Some lenders are trying to improve the productivity, but really speaking, the correlation between the deposit market share and the branch market share in India has been very, very high to the extent of 95%. So therefore, in our opinion, banks will need to keep doing hard work of reaching out to the customer at the ground level by expanding the distribution footprint, which is there for some of the banks, but some of the banks are yet to follow that suit.
And Rahul, of course, we've heard from the regulators they're concerned about shadow lending. Your thoughts on what the risks are out there?
So clearly, I think what the regulatory action seems to imply is that there is very little scope for any loose governing standards or governance standards, so to speak. And in our opinion, what the lenders or what the investors are discussing with us is that the regulatory arbitrage that existed between the banks and the shadow lenders seems to be thinning away. And that's what RBI is focusing on. About a couple of years back, RBI unveiled a new governance structure for the non-bank finance companies that perhaps left a very little room for the non-bank finance companies or shadow lenders, as you rightly call, or as you called. They need to keep working hard on improving their governance standards. And therefore, wherever there is any lacunae or any gaps, those lenders perhaps will need to answer to the regulators. But from our perspective, when we look at the broader space that has both SOEs, private banks, as well as the non-bank finance companies, we tend to prefer banks and the lenders that have got strong visibility on their operating profit growth over the next couple of years, coupled with strong governance standards.
Do you see regulators coming down further on shadow lending, or do you think this is it?
Difficult to estimate, to be honest. So therefore, we are focusing more on fundamentals. We're advising investors to just keep an eye on how these different lenders are behaving differently, which segments they are growing, particularly because there is definitely a sense that if you're growing aggressively in the sensitive sectors, such as unsecured lending, which of course, where the doubts exist, whether this money is being used for consumption purposes or it is getting routed to the stock markets, you need to be careful. And therefore, one needs to focus on the quality of lending growth these lenders are delivering and what kind of a profitability they're making, coupled with the quality of the portfolios.
Rahul, we've seen how global banks have been cutting jobs in a huge way, yet Indian banks have been hiring in a huge way. How are you reading this? Can they sustain that kind of hiring?
The answer lies in the previous two questions that you asked, Haslinda. One is the structural drivers for lending growth, which we still feel pretty much intact, with nominal GDP growth is expected to be closer to 10% or maybe more. That will translate to a healthy loan growth for the banking system. And for that, the lenders will need to hire more and more workforce to support that momentum. And second is deposits, which you just briefly discussed as to what the lenders could do. And therefore, hiring employees is also very much part of the capacity expansion plan. The lenders cannot really shy away from investing in the capacity build out because they need to travel a long journey. And therefore, that's the reason why the lenders are still hiring in huge numbers compared to the global environment.
Rahul, great insights. Thank you so much for joining us. Rahul Jain from Goldman Sachs. Well, it has been trading for about 7 minutes now. Let's do a check on how they're doing right now. We know that Indian stocks are under pressure in line with the rest of the region, which has been pretty much supported by that run-up in Hong Kong stocks playing catch-up. Let's do a check on where they are. The Sensex index down 0.3%. Nifty index also lower, along with the Nifty Bank index down 0.3%. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back, and it is a muted session here in Asia on the back of that better than expected eco data out of the US. Here in Asia, we're seeing the likes of tech and energy leading stocks up. The MSCI Asia Pac index up by 0.4%. It is pretty much lifted by the Hang Seng in particular. Back after holidays, strong China data boosting sentiment, in the likes of Xiaomi jumping as much as 15% on early signs of success for its EV SUV. Lots of demand, 90,000 orders within a 24-hour period. Flip the page. Take a look where we are in terms of those U.S. treasuries. Of course, we had treasury yields higher across the board. 10-year yields jumping about 11 basis points near that 2024 highs. And that's on the back of that stronger than anticipated eco data supporting the Fed's view of higher for longer. Bond traders now are pretty much pricing in a less than 50% chance of that hike in June, likely to be in September, they say. Well, higher for longer, phrase we have heard for so long. This is how it's looking in terms of the broader market. Hang Seng Index leading the pack up by 2.4%. And in terms of the FX space, we continue to keep track of the yen, inching ever so close to that 152 level. That is it from Bloomberg Markets Asia. Daybreak Middle East and Africa is next. Keep it here with us. This is Bloomberg.